The last topic in chapter 5 is about loan amortization. And amortized loan basically is a loan structured for annual payments that will completely pay off the debt over time. So when the debt is paid off over time, by the end, the balance of the loan should be zero. And amortization tables are widely used for home mortgages, auto loans, and business loans, and etc. We can use financial calculators and spreadsheets to help us set up amortization tables to analyze loan amortization problems. So let's take a look at an example. If we want a car loan of $10,000, that is the principal of the loan. That is also the present value of all the future payments for the loan. So the loan is for 4 years and interest rate is 9% per year. And first we want to find out how much is the monthly payment. If this is a monthly payment question, then we want to look at the number of months. And 4 years means 48 months, 48 monthly payments. 9% loan, that means 0.75% monthly interest rate, which is 9 divided by 12. And the loan amount is $10,000. So the present value of this loan, or say of all the future loan payments, is $10,000. We put these numbers into the calculator. We compute for the payment. The payment is about $248.85. So that means in the next 4 years, every month you're gonna make a fixed amount of payment of $248.85. And if you manage to do that, then in 4 years you will pay off the loan and your balance will be zero. Since in this calculation, since number of payments is about monthly and the interest rate here used is also monthly, we know the payment result we get is the monthly payment. Common mistake here is to calculate the annual payment based on 4 years 9% interest rate and use the payment amount divided by 12 to get the monthly payment. That would be incorrect. So again, to calculate the monthly payment, you solve this payment under monthly settings. Once we calculate the monthly payments, let's take a look at the structure of the loan. So if we want to find the interest paid in the first month, we know we start with a principal, or say balance of $10,000, and within the first month we will be paying a 0.075% interest rate. So that means we are paying a $75 interest in the first month. And remember, the total payment we are making in the first month or every month is $248.85. So we can think of this $248.85 total payment as a sum of interest payment and also principal payment. Interest payment is $75. That means the principal payment is $173.85. So this principal payment will be used to deduct your balance, which means after the first payment, your ending balance will be $173.85 lower. So your ending balance now is lowered to $9,826.15. So this is how we look at the first month and see that once you make your first payment, your ending balance, the balance of your loan will get lower. And we can also look month by month, but to save some time, we're not really gonna calculate month by month. We can just simply look at the table 5.6, which is a so-called amortization schedule table. If you look at the first line, this is month 1, and this is pretty consistent with what we just talked about. payment of $248.85, and out of that $75 paid as interest and $173.85 paid as principal. Then after that your balance is lowered to $9,826.15. And you notice that in the second month you start with the ending balance from the first month, and you're still paying a $248.85 payments, and you see all these 48 months you are paying the same fixed amount of payment, $248.85. However, since your balance lowered, then your interest will be lowered, because the $73.70 here is your balance of $9,826 multiplied by the 0.75% monthly interest rate. Now remember, your total payment is fixed, so within your total payment, if the interest paid is lowered, then your principal paid actually gets higher. So you notice this number is higher than 173. And again, after you make $175.15 principal payments, your balance will be lowered from $98.26 to $96.51, and the difference between $98.26 and $96.51 is the $175.15. So let's take a look at these checkpoint questions. From the amortization table, if you want to sell the car after 2 years, how much would you have to pay to the car loan company? So in other words, what is the remaining balance from this loan after 2 years of payment? The amortization schedule shows that if you wish to sell the car after 2 years, which is after 24 monthly payments, then you will have to pay the car loan the remaining balance of $5,447. So let's see if that's the case. 24 months. After 24 months, your remaining balance is $5,447.13. So that's how we got that number. What if we want to look at, for example, some interest payment or principal payment question? We're trying to use our financial calculator to help us figure out some interest or principal payment questions. So here I'm using the instruction for TIBA2 Plus, but for TI-83 calculator you can also use your calculator. I do have the instruction at the end of that video tutorial for TI-83 users. Anyway, so if we are trying to use TIBA2 Plus calculator to calculate some interest or principal payment questions, or say to figure out some amortization questions, first we want to find the amount of the monthly payment. So this is just to input all these variables and compute for payments. You do need to go through this step just to enter the numbers and calculate the payment, so the information is stored in your calculator. Now you want to find the amort function, which is just above the PV key. So it's the second function, you want to go second amort, and you want to input P1 as 2 and P2 as 2. And by the way, for TIBA2 Plus users, you should also be able to find a detailed instruction of this in your video tutorial by the end of the tutorial from that video on D2L. Okay, so once you do P1 is 2 and P2 is 2, you see that your screen will show BAL equals this much. So that is the remaining balance after 2 months, or say 2 payments. And if you press the down arrow, you can see the PRN equals to 175.15. Now 175.15 is the principal payment made at the second month. And also if you press the down arrow again, you see INT equals to 73.7. That is the amount of interest payments in the second month. And by the way, let's go back to the amortization schedule. You see the 73.70 and 175.15. These are consistent with what we were talking about here. And so now you get the idea that we can use the financial calculator to find out the interest paid, principal paid, and also remaining balance after certain payments or say certain period of time in the amortization process. So for example, now if you want to compute, if you are asked to compute the total interest that you will have to pay during the first 2 years. During the first 2 years, that means the first 24 payments. So you will have to enter P1 as 1 and P2 as 24. That basically means from the first payment to the 24th payments, a total of 24 payments. And you find the remaining balance, and you also find total interest payment, which is $1,408.19. So that tells you that if you make the first 24 payments within all those money that you paid, $1,419 are paid toward interest in these 2 years, in the first 2 years. Okay. Again, please refer to the video tutorial I uploaded on D2L about how to use your financial calculator, no matter whether it's TIBA2 Plus or TI 83 or 84 for these kind of amortization problems. I give more detailed explanation about how to use your financial calculator and what to do, what to input to calculate all these BAL, INT, or principal payments. So, so far we talk in this video clip we talk about amortization problems. You are expected to know how to calculate the payment of an amortized loan, and you are also expected to know how to find the interest payment or principal payment or the remaining balance from the amortized loan, or say from the loan amortization process. No matter whether we are looking at just one payment or we are looking at payments across a whole year, 2 years, or the first 5 years. To summarize the whole chapter 5, here we have a list of topics covered in this whole chapter. And by the way, if you look at the whole chapter 5, you notice it's really long. It has more than 60 pages, and it covers a lot of topics. So we are talking about future value and present value of uneven cash flows. We're talking about future value and present value of ordinary annuities and also annuity deals. We also talk about present value of a perpetuity, which basically is an annuity that goes forever. And we talk about how frequent compounding can affect the future value or present value of an annuity or a single cash flow. And based on that, we try to calculate the so-called effective annual interest rate. So you are expected to explain the relationship between the compounding frequency and the effective annual rate. Actually, I would say it's pretty simple. Higher frequency than higher effective annual rate, right? And you are also expected to explain the amortization schedule, including calculating the payment from amortized loan, and also you should be able to find the remaining balance of a loan after several payments or several years. You're also expected to know how to calculate to find out the interest or principal payment from the loan within a period of time or after a period of time. So that's the whole chapter 5. I would say keep practicing with your Learn Smart questions or the practice set questions, and that pretty much is the only way to get comfortable with all these concepts and calculations in chapter 4 and 5 and get ready for the exam. If you have any questions, feel free to post your questions on D2L on the discussion board, and also feel free to email me your questions.